Hello, everyone. Welcome to today's webinar, Financial Statement Basics. This webinar is being recorded. The presentation will be emailed to you. If you have any questions, please type them in the chat. Questions will be answered at the end of the presentation. And now I will turn it over to your facilitator for today, Mr. Bill Oakes. Bill, thank you so much for your time. Thank you.
Thank you, Christina, and thank you to everyone who's in attendance. We appreciate you taking the time to join us today. My name is Bill Oakes. I'm actually a member of the Silicon Valley SCORE, but I'm pleased to be making this presentation to the good folks in the Central Valley. My background briefly is that for many years in San Jose, I had my own small business. I operated as a small proprietor. We did small business bookkeeping, accounting, tax return preparation, taxpayer representation, and got into personal financial planning for the clients. I have my credentials as an enrolled agent, which is a tax credential, and I'm also a certified financial planner. They asked me to make a brief statement about myself. Hopefully that's short enough and sweet enough for everyone. I always turn off my video. There's two purposes in that. One, it enhances your viewing pleasure. And secondly, it preserves some bandwidth on my end so that my internet doesn't drop out. If it does drop out, I'm usually back within a moment or two. I'll thank you for your patience if that situation occurs. SCORE is a national organization. There are over 250 chapters scattered around the country with probably more than 10,000 mentors available to assist you. Our goal at SCORE, very briefly, is to help people form and start their businesses, and for existing businesses to help them grow and achieve their goals. We accomplish this through free mentoring sessions. You don't pay for any of the mentoring sessions you may sign up for. At SCORE, you have an unlimited number of these sessions, and we also provide lots of seminars and workshops such as these. Your material contains a link to the National SCORE website, score.org, and also to the Central Valley website. At either of those websites, you can review available seminars, review biographies of mentors, and sign up for a free mentoring session. So that's the SCORE story. That's my story. What's the story we want to cover for you today? Well, it's all about understanding your financial statements. And we're going to cover this basically starting at the beginning with a little bit about bookkeeping. We're not going to turn it into a bookkeeping session. That's really some background information for you. We'll take an overview look at some key financial statements, the income statement, the balance sheet, and the cash flow statement. Identify what those are, what they do, and then we're going to dive into each one of those statements individually and look at the concepts, the terms that are involved in each of the statements, and some examples of each of the statements. And then at the tail end of the session, we'll get into what's going on behind all these numbers. It's interesting to have the numbers. They can give you some information about your business, but there's many other ways you can use them. I strongly advocate that you become familiar with using the numbers, not just for your tax return, but to do some critical analysis about your business. And that's why I've included some information at the tail end of this session about how do we do that? What's going on behind the numbers? And we'll use some comparisons, some ratios. A key element will be the break-even point, and then we'll wrap up the session for you. So that's the game plan. We have this set aside for 2 hours. In the past, making this presentation, the bookkeeping will probably take us about 15 or 20 minutes. The three main statements, income statement, balance sheet, cash flow, and the overview, that's probably going to take us out to about an hour and 15 minutes, and that'll leave us good 20 to 30 minutes to do the behind your numbers and save some time for questions. So that's basically the game plan. The other administrative issue would be if you have questions, and because we have so many attendees, there's already 25 folks in the room, please enter your questions into the Q&A box or the webinar chat box. I'll try to watch them as we go through and may weave in some answers to some of the questions as I see them. And we're certainly going to save time at the end of the session to go back and pick up all the questions and answer them. So that's the game plan. The administrative issues are addressed. You will receive copies of this material. That's a frequent question, so we'll answer that up front, that copies will be available at the end of the session. We know what the agenda was, what's really the objectives of this workshop. We want to demystify the financial statements. The key word here is plain language. One of the things I've found in the years of working with small business owners is that when they start thinking about financial statements, when they start engaging in conversations with their professionals about financial statements, as if the business owner has been transported to a foreign world with a different language, cultures, and customs. If we can demystify some of this today, make you more comfortable with some of the terminology, comfortable with some of the statements and what they are conceptually, then you'll have better conversations with your financial advisors, whether that's a tax advisor, a lender that you might be dealing with, perhaps an investor that wants to invest in your company, some of your management team to understand the business operations. You'll be more comfortable and confident in having those conversations. That's certainly one of the main objectives of this system, of this session, is to become aware of these statements, become comfortable with the terminology and concepts, so you can do a better job in operating your business and utilizing the very valuable information that's available to you. Question popped into the Q&A box, PDF available. That will be made available to you later on after the session, I believe. Christina might be addressing that one for you. What are these financial and operational piece of information that we want to use? We want to take some time up front to set them up correctly. And that's part of why we want to include information about the bookkeeping. The bookkeeping is the skeleton that we put a lot of information on. We hang a lot of weight on the skeleton of the bookkeeping subsystem. And we have to set them up so we understand how we're going to record transactions, and then we can better understand the transactions that we're entering, that they're going in the right places in the system. As a side point, and very important also, is to be aware that many of the accounting systems that accommodate the bookkeeping feature and perform that function for you are places where you can capture additional information about your business, its performance, your clientele, that you can use then in making more business decisions and making better business decisions for yourself and your business. So there's a lot of information that you'll be collecting through bookkeeping that you'll be using in managing the business, and you'll be managing in day-to-day decisions and in long-term planning. You'll be managing this information and using it with regard to tax return preparation, tax return planning, tax strategies, and you'll be using it to present your business to potential lenders and investors. So there's a financial side, and then there's going to be some things behind that that you'll want to be aware of, that your financial accounting system will accommodate. For example, perhaps you're a contractor and you go out and you put a bid in on somebody's job, and you give them a quote about how much it will cost and how long it will take to accomplish the job. That can be captured in these systems. You can then look back at some of the quotes and bids you've submitted, and determine which ones were successful, and make plans about which ones you want to tune up your presentation, how you can gather more business through a better presentation of your bid and follow up perhaps on some of these things. You can collect information about customer demographics. So there's a lot of very valuable information in the financial system. Again, if we can learn some of these techniques and what to build into the system, we'll be more successful at extracting the data that we're looking to get from it, because we took the time to set it up correctly at the beginning. It all starts with bookkeeping. Every transaction for the business needs to be recorded in the accounting system. A common question I get is, well, what are some good small business accounting systems? Everybody's probably familiar with QuickBooks. There's Sage, there's also Xero. Those are the first three that come to mind. There's FreshBooks. I'm clicking some information into the chat box for you. I typed in 4 different small business accounting systems: QuickBooks, Sage, Xero, FreshBooks are some of the ones that are available that you could research and see which one might be suitable for your business. Some of these companies that provide these systems, these applications, will also allow you to do a trial run, a trial version of it. In the bookkeeping system that these accounting applications are doing for you, we're going to record the sales transactions. What did we sell? What kind of products do we offer to our customers? What kind of services do we offer to our customers? If we're building a widget and the widget has 10 different components, then there's some materials that we put together into our efforts to make the widget to sell to our customers. So we buy some things. We might buy office supplies. We might have equipment such as computers or furniture for our clients and customers to sit on or use while they're in our space. We're going to be paying rent perhaps on our building. We might have insurance on our business. You might be doing advertising and marketing. You may be consulting with an attorney about some legal documents for your business. There's lots of different expenses associated with running the business. And the accounting system, the bookkeeping system will accommodate this for you. Other things you might be doing and recording is you might be getting a loan and you might be making payments on the loan. Perhaps you buy some equipment and you get a loan with that equipment. So you have to enter the asset and you're going to record a liability. And now I'm using some terms you may not be aware of or be comfortable with, but we're going to define them in just a few moments here. But the bookkeeping is where we keep track of all this. Every financial transaction for the business gets recorded in the bookkeeping system. And again, some of the common systems for small business owners are QuickBooks, Sage, Xero, FreshBooks. Some people use Excel spreadsheets. These are all possibilities for you. What do we use? Here's QuickBooks, that's mentioned. I mentioned Excel also. I'm going to beat the drum again about setting up the bookkeeping carefully for your business. You may want to spend some time and a little bit of money to work with your tax accountant to make sure the bookkeeping system is set up correctly from the beginning. Most of the systems are easily altered, modified, adjusted to suit your needs even after you're up and running. But it's good to spend some time thinking upfront and planning about your business and what it will do and what types of data you would like to retrieve from it so that you can properly set it up. It's almost like building a house. The bookkeeping system is the slab, it's the concrete base for the house. It holds everything else up. We have to think about what features will be in the house, how we're going to distribute the weight. We need a good, solid foundation to the financial house, and that is the bookkeeping system. You wouldn't build a house and start acquiring all your lumber and roofing material. You would be first putting in the slab, the foundation for your home. So the same thing with your financial system. Make sure you have a good foundation. Think carefully about what you want to analyze and run your business. We're going to have some examples of this as we go through. We're just kind of teeing it up for you at this point that you need to be thinking a little bit into the future, what we hope to get out of this system. Let's plan to set it up correctly so we can get that information out into the future. And to back that up a little bit, here's an example of a SCORE client that we have that has 3 different types of income sources. The person has some support group activities, skill development courses that they offer, and they also do specialized classes on one-time specific topics. So this person has sat down and thought about, I'm going to sell a service, basically. Not selling products in this company, they're selling services. So they've made that distinction and they've gone a step further and they've identified 3 different types of services: the support group, the skill development, and the specific topic class that they want to run or occasionally run. And they're going to collect information about each one of them. And what you'll see on the next slide or 2 is a little bit of a breakdown here, that there will be financial information associated with each of these services that are offered to their clientele. Additionally, in the background, there's other pieces of data that can be gained and captured in the accounting system, in your bookkeeping system. And what's the purpose of each of these? Very quickly, the support group. This is really an introductory service with a nominal fee to potential clients. And the person who owns this business charges a couple of bucks, mainly to cover the snacks she's offering or to pay for the rent of the facility she may have to rent, to get people in the door and show them a little bit about what she does and the value of that to them, the potential value of that to these potential customers. Her hope from that is that customers will come out of that session and say, now this person has some very good services. We could use them in our business or perhaps in our personal area if there's personal skills that this person is offering through her business. And so she hopes somebody signs up for some of these skill development classes. Now she's going to be able to charge a higher fee for people to be in that class. It's going to be much more in depth. And the original support group was a surface level conceptual look at what's available. And then the idea was to lure people in to sign up for these skill development classes where she charges a fee that allows her to operate a profitable business. Additionally, somebody will come to her after a class, a support group, and say, I really need not exactly what you have, but something a little bit different, or do you offer a topic on something like this? And she may actually develop it or know someone who does that work and bring in that other person as a subcontractor or even develop the material herself. So that's conceptually what's going on in this business. The key thing here from the financial perspective is that she has three sources of income: the support group, skills development, and it's the specific topics agenda that she offers. And here's where we break it down into a little bit more detail on financial information and non-financial information. Well, I'll just walk through one of these, but the initial one, the support group gatherings, what financial information do we gather? Well, she's going to collect a nominal fee from the participants and just pay for the chips and the sodas or whatever she's offering to the folks for this session. So there's a little bit of a financial cost, and she's going to try to recover that with a nominal fee from the participants. What else is she getting? How many people come to these things? When does she offer these things? Now, this is where you get to the critical analysis of this and start thinking about this. When do you offer these sessions? What is the attendance at the different sessions? Do more people come to morning sessions? Do they come to lunchtime sessions? Do they come to evening sessions or late afternoon sessions? When do we get the best attendance? Right? Maybe we want to focus our efforts on marketing these sessions only in one or two of these time slots, not all through the day. Right? What are the people saying about these things? Are we giving them enough information? Do they have any comments about the material, about the snacks, about the presenter, whatever it might be, so that we can be better in the future? How many of these folks actually sign up for step 2 skills development or opt into specific topic classes? So we're drawing a lot of information about business performance, non-financial business performance, by paying attention to some of these other factors that come out of presenting the business in these support group settings. So think about this when you're setting up your business. What are you selling? What types of financial information can you gather? And that's why there's this little sample worksheet. We're not going to stop and have you to fill out the worksheet and discuss everybody's worksheet, but take this home and think about your business and what kind of financial information you want to gather and what else is behind it that you can gather. And will these bookkeeping systems help you accomplish that goal of picking up other non-financial pieces of data to help you run your business? So this is a quick look at bookkeeping, the importance of bookkeeping. I'm going to come back to some of these concepts and topics as we go through the next section and dive into the details about some of these. So if you think about it, where does all this start, your financial system? The financial system starts with the transactions and the activities. That's the bookkeeping we just talked about. And these are transactions that happen throughout the life of your business. Every day something happens in the donut store, and somebody comes in and buys a dozen, somebody else buys half a dozen. We have to record all those transactions. We have to go out and buy more flour and apple jelly or whatever we're using in the donuts. And we have to capture those costs associated with it also. So that's an ongoing activity to capture all that in the bookkeeping system. The income statement, balance sheet, and cash flow statements are produced out of the bookkeeping system. Some of these names, income statement, balance sheet, cash flow, have some aliases or other names, and you'll see some of that as we go through the upcoming material. The income statement, and it's really a good little graphic here that it's like the old motion pictures where there's a movie camera rolling and the tape runs through the projector reel to reel. But the income statement is during a time period. It measures the company's performance over a time period. That's all it is. Some people call it a profit and loss statement. So it's just from January 1st of 2023 till January 31st of 2023. Here's what we sold. Here's how much it cost us, and here's our bottom line or our profit. This is just at this point in the presentation, this is just a conceptual level, right? It's just a conceptual level. What are these things? We're going to dive into the detail in the next hour or so. We'll dive into the detail of each of these statements, the income statement, the balance sheet, and the cash flow. We'll get into some samples. We'll get into some more terminology on these. So the income statement over a time period, how do we do? How do we perform? Balance sheet, it's not a time period question, it's a camera, it's a snapshot, right? It's just a snapshot. We take a picture at a point in time of the company's financial position. And the financial position of the company is determined by its assets, which are things that are owned, and by its liabilities, which are amounts that are due to other parties. So it's a snapshot. What do we own? Who do we owe money to? What's the difference? And the difference has another term tied to it. It's called equity. We're going to get into more detail again. This is just introductory information, conceptual level. Balance sheet is a snapshot. On January 31st, this company had this much money in the bank and they owed $10,000 on a loan. And so we have a snapshot of where they are financially at a point in time. The cash flow statement is, again, over a period of time. So the cash flow and the income statement measure things over time periods. The balance sheet is at a point in time. And the cash flow statement is different than the other two. And the cash flow statement will say, analyze where did the money come from and where did the management of the company decide to spend that money? Where did it go to? So at a conceptual level, that's just where'd the money come from, where'd it go to? There's a lot of detail behind this. We're getting to it. This is where we want to break away from the bookkeeping and transition into financial statements, what these things are. There's a bit of a narrative description of each of these that we'll get into. There are different aspects of the state of the company. They're not independent. They are linked. There's information that flows from one into the other one or back and forth. So some information will come off the income statement, go to the balance sheet. Some information will come off the income statement, go to the cash flow. The cash flow will take information from the balance sheet and the income statement. There's a lot of interaction. We'll show some of the linkages. I'm sure with that last quick discussion that there's a lot of information flying around from statement to statement. Some people might be rolling their eyes. It's fairly logical. We hope again that the basics we can get across to you today and you feel comfortable with moving between these things. Because one of your jobs as the owner of the business is you don't have to be a CPA. I'm not trying to turn everybody in today's session into a certified public accountant, an enrolled agent, a certified bookkeeper. You don't need to go to that level of detail, but you do need to have an understanding of what's going on, because these statements are the lifeblood of your business, and nobody else cares more about your business than you do. So you need to get comfortable with these things. I'm banging the drum, I'm on my soapbox. If you don't do this, no one else will. And some people may take advantage of you because you're ignoring it. I know some people are afraid of this. Again, my mission today is to make you less afraid of it, more comfortable. I apologize every time I get on the soapbox. I've been doing this a long time. I had my business for 30 years in San Jose, helping small business owners. I've seen some good stories. I've seen some terrible stories. Please get comfortable with this. Pay some attention. You don't have to be an expert, but please get comfortable with it. Use your SCORE mentors to ask questions as you go through the years. Develop a good set of professional financial advisors to help you with all this. Okay, I'm off the soapbox. I'll warn you when I get up there. More details. The income statement is also known as a profit and loss statement. We're going to break this into 2 or 3 slides so you can get comfortable with it, and then we'll look at a sample income statement after we go through it conceptually. So if you pulled or printed an income statement for your business or looked at somebody else's business, it would look something like this. The first line item would be sales. What did we sell? You'll see there's, in some cases, a definition entry. In some cases, they give you some of the aliases, the other names that you may see. They'll say, what's your revenue statement? It's just a profit and loss statement. What's your top line is your sales. And your sales can also be called revenue. You may subtract some things from sales if you have some costs associated with things that you're selling. So the next 2 items you see here, net sales and cost of goods sold, these may be costs you have with putting together the widget. Remember, I had a widget shop and there were 10 components I packaged together into a completed widget. And what were my costs for that? Well, I had to pay for the individual components. I had to pay somebody in the factory to pull the 10 or 15 components and pack it into a widget. And then maybe I have to ship it someplace, so there's freight associated with each sale, and maybe I have a salesperson in the field selling the widgets. So I have these costs that are directly associated with the product that's being sold. I'm making a distinction now. Sometimes your business will sell products, and some businesses don't sell products and they just sell services. And some businesses may do some of each. They may sell products and they may sell services. But you really want to check, particularly if you're selling products, to understand what your gross profit is. The idea is if it costs me $100 a day to make the donuts, and I sell $200 worth of donuts every day, my gross margin is $100, right? I sold $200 worth of donuts. It cost me $100 to put the donuts together. My gross margin is $100. You should always have a positive gross margin. If your gross margin is negative, there's something wrong, right? I'm going to sell $200 worth of donuts, but it cost me $400 to put the donuts together. This is not a good business model. We need to change some things here. But you'll use this gross margin to see how your business trends change over time. And sometimes your cost of sales may be up or down. Well, why is that? What can I do to improve the situation so I can maintain or improve my gross margin? So this is the very top of the income statement, the first 5, 10, 15 lines, depending on the complexity of your accounting system. It could be just a few lines and might be 10 or 15 lines for this cost of goods section and determining your gross margin. We know we're not done. There's other things that happen in this business, right, that we have to pay to keep the lights on. We're going to pay a cell phone bill. We do advertising. We have insurance in case somebody falls in the donut shop. We pay the landlord. We pay the counter people who sell the donuts, interact with customers. We have all these other things going on that cost money to run the business. When we subtract those items out, we subtract out these operating expenses, which have several aliases on the right-hand side. They're sometimes called fixed costs, general administrative and selling costs. Then we have our operating income after we subtract that out. And that's after typical business operations. Now, the next little section in the income statement is the treatment of earnings before interest, depreciation, taxes, amortization. This is the term EBITDA, EBITDA, earnings before interest, taxes, depreciation, amortization. Many small business owners aren't aware of this or don't pay any attention to it, and it's unnecessary for them, so please don't get hung up on it. If you watch the financial news and you're interested in trading stocks and investing in companies, lots of times talking heads on the financial news shows will talk about EBITDA. For most small business owners, it's unnecessary, it's overkill. Yes, you may have some interest, you may pay some taxes, there might be some depreciation, but it's not to be overstressed. Okay, and many times these are non-operating expenses. It doesn't have to do with running the business. It has to do with the fact that equipment wears out and we depreciate, or that we're paying interest on a loan. We take out all this other stuff. You have your net income or bottom line. That's an alias for what's also called net profit or loss. So now we have the bottom line. How did we do during this time period? So again, at a conceptual level, these are the parts of your income statement. There's a statement of the income, the sales that you had, then we subtract out the cost of goods if you had any, and then we subtract out all the other operating expenses, resulting in a bottom line or net profit. If you're an attorney, if you're a technical consultant, you may not have any cost of goods sold. If you're an accountant, you may not have any cost of goods sold. A doctor, if there's any doctors that are operating independently these days, that would be pretty rare and unusual. They may not have any cost of goods sold. Okay, so these are the concepts. What does a sample income statement look like? It looks like this. This is a very simple one. There's a statement of revenue. All the titles we saw on the previous slide are being repeated here. There's a statement of revenue, then there's the cost of goods sold section. We determine the gross profit. We take out the operating expenses. Then we take out non-operating expenses for the interest and depreciation. We end up with a net profit on the bottom line. Just a couple of highlights here. My apologies. There we go. So a couple of comments about this. You'll notice that the percentages are on the right-hand column. The comment about the percentages, I like to see them. Most financial professionals like to see percentages because it's easier to compare percentages of the current report against prior reports. I could look at the numbers of 55,000 and 50,000 net revenue, but how's that compared to last time? And maybe last time it was 25,000. Oh, that's a big jump, but why? What's going on? I could see, some differences here as I go through the analysis on this in comparison to previous statements. And sometimes it's easier to see a big difference in the percentage rather than trying to eyeball all the numbers and comparing all the numbers. So this place had net revenue of 50,000. That's because they had 55 in sales, 5,000 in commissions. They paid a commission salesperson. They had 50,000. They had $30,000 in cost of goods sold. So their gross profit was $20,000. That's good. I always want to see a positive gross profit. That's 40% of their revenues fell through to be profits. That's pretty good. Now, one of the other things you'll do, and we'll talk about at the end of the session, is not only compare these numbers against your recent numbers over similar time periods, but to compare them against industry standards. And the key word there is industry standards. We'll come back to that. After we have the $20,000 in gross profit, we have the operating expenses, some non-operating expenses, and we end up with a net profit of $5,000 for this business on sales, net sales of $50,000. And that's a 10% net profit margin. Is that good or bad? That's going to depend. How does it compare to the last one that you had? And what industry are you in, right? If this was a grocery store, you'd say that's wonderful, a 10% profit. If it was a restaurant, you say that's pretty darn good too. Grocery stores and restaurants don't have high net profit percentages. So you have to do apples to apples comparisons. You wouldn't compare the financial statements, we'll pick some big companies, or you wouldn't compare the financial statements of Walt Disney, the Disney company, versus the financial statements of Google or Apple, a high-tech company. They're in completely different industries. They have different cost of goods sold, different salary levels they pay their workers, different insurance requirements they have. It's apples to oranges. Do apples to apples comparisons when you're doing the analysis. What do your numbers say in comparison to your previous numbers over the same time period? And how does that compare to some industry averages? And at the tail end of the session, we have some places where you can pick up some industry statistics. The other thing I want to mention on this before we move off of this slide, it's a pet peeve of mine, and will get me on the soapbox, so you've been forewarned. There's a statement here, sales, right? And it's $55,000. If you remember the sample bookkeeping program we looked at earlier was for a score customer who had 3 sources of revenue. There were the initial introductory sessions she ran, the in-depth skill development sessions that she ran, and then customized sessions that she would run. So when you think about your business and you put together what you want to track, my strong recommendation, the rant is, don't just simply say sales. Back to that example of this woman with that business, she should have sales of introductory sessions, sales of in-depth sessions, and sales of customized sessions, something like that. But we can differentiate the 3 main sources of income that she has, and then we can look at each one of them to see how we're doing in terms of profits. The reason why I'm on the soapbox is that years ago, I went out to see a potential client. Her name is Sharon. You'll hear some of these horror stories as I go through the session. It just, I think, brings some things to life. I went into Sharon's shop. Sharon's shop was a retail operation. She sold paint, wallpaper, flooring, accessories for the paint, accessories for the home, carpeting, things like that. She would also do design work. So she had a lot of things going on. I said, Sharon, I always like to know new clients, do you have an income statement? Could I see that? And she brought out last year's income statement, and it said sales, $500,000 or whatever the number was. I said, interesting. I see you have a lot of paint in the store. You have some wallpaper over there. Looks like you offer some interior design services. How much of interior design services did you sell? How much wallpaper did you sell? And she just looked at me and said, I just showed you the income statement. It's all here. It's sales, $500,000. I said, yeah, but I'm wondering if, you could tell me how much Benjamin Moore paint you sold and how much Kelly paint you sold. And now she said, she's getting a little bit irritated and said, Bill, I just don't you see this paper? There's an income statement here of $500,000 in sales. It's all there. And I said, okay, now we're both getting a little irritated with each other. I said, okay, well, really what I'm asking is, can we tell which one of these is profitable? And to do that, we need to understand how much paint you sold. And if you have 3 or 4 different types of paint you sell, Behr and Kelly Moore and whoever else is selling paint these days, let's break it out, right? And if you sell different types of wallpaper and you do different types of interior design, we need to break those things out so you can make some better financial decisions. And that's what we ended up doing. We went back and we put her into our bookkeeping system, and we created a new bookkeeping system for her and identified sales of Kelly Moore paint, sales of Sherwin-Williams paint, sales of Behr paint, interior design jobs, residential interior design jobs consulting, where we weren't selling things, just doing the design work. So there was a lot more information she could get out of her income statement by properly setting the foundation for the accounting system, for the accounting house, having a good sound foundation. So this is just an example of an income statement. Don't be afraid of it. This is the flow. Some of the numbers here will move to and have an impact on some of the other statements that we'll take a look at. What we want you to think about, again, is in becoming comfortable about this, think about what you need to track. And here's the question I was trying to get Sharon to answer. What are your different product lines? What are you selling? How can we determine which is profitable and which is not profitable? What line items do you have that might go into your cost of goods sold? Right, so if she's selling gallons of paint, how much is she paying Sherwin-Williams for the paint? Right? Not just say cost of goods sold, one line item. We want to know what we're making on each gallon of Kelly Moore paint that's going out the door. What do we pay for that gallon? What do we sell it for? Do we have a positive gross profit margin? What do we track under operating and non-operating expenses? So there's all these things you think about as you're setting up your accounting system. Excuse me. Now, one word that's one term that's not in your workbook that is suitable to introduce at this point in time, it's called the chart of accounts. What we're asking you to do on this slide is make a list of all the different things you're going to sell, of all the different things you're going to buy, and of all the different operating and non-operating expenses you have. All of what's on this, it's just a list, really. The technical accounting word that you'll bump into, it's called a chart of accounts. And a chart of accounts is simply a list of all the categories that you want to capture financial information on, and will also allow you to capture additional information about your business. But take some time, think about your business, what you're doing now, and if you have a general statement like sales, and that's how you're capturing your business income, take some time, think about what's going on in your shop, in your business, and break it out in a finer level of detail and update your chart of accounts. Don't be afraid of the terminology chart of accounts. It's just a list. Now, one of the things I like business owners to do also is typically you'll see the income statement is done on a monthly version. What I like you to do, and all the accounting packages will accommodate this, the reporting mechanisms are fairly friendly, and you can say, I want to look at my business performance. Now we've just finished the end of May. What I might want to do is by month, get a report that says what happened each month in my business. And now I have 5 months of history to look back on. And I would look back on these 5 months and say, are there any surprises here? Any unexpected numbers? Why is that? What do I want to do about it? So I'm going to first examine it with regard to this year. Then I'm going to open up the window a little bit more, and I'm going to say, well, wait a minute. Let's go back to 2022 and say, what were the first 5 months like? And how do the first 5 months of 2022 compare against the first 5 months of 2023? Right? And say, how come there's such a big difference here in 23 versus 22? And there may be reasons for that, but you need to examine that, understand what's going on with the business, and perhaps you'll be making some other changes to improve the business outlook based on a review of these financial statements. So look at it every month, and at least every quarter, take a 3-month look back. Every 6 months, look back over the half year. And out in the fall, because I'm a tax person, that's a lot of my background. It's a good time out in October to take another look at the January through September performance and think about the remaining 90 days in the tax year and what strategies you might put into play to try to relieve some tax pain at the end of the year. And so we've included just a little bit of a note about taxes. I won't turn it into a tax class on you. If you run a sole proprietor, you will report your business income on Schedule C. That business income will be subject to regular ordinary income taxes, and it will also be subject to something called self-employment tax. Self-employment tax is the business owner's way of paying Social Security and Medicare taxes. They're calculated separately from your income tax. So your net profits are subject to both of these taxes: Social Security taxes, Medicare taxes, and on the other side, the regular income taxes. In a partnership, we'll have 2 or more people owning the business. They will complete a Schedule 1065, a Form 1065 for the partnership. That partnership form will include K-1s, which are reports to each of the partners of their share of the business's profit and losses. And those partners who receive the K-1s are responsible for taking that K-1 information and reporting it on the appropriate places on their 1040 forms. So this is called a pass-through entity. The partnership passes through the income and the tax responsibility to the owners of the business via the K-1. And again, to close the loop, the partnership files a 1065 form. The S corporation and limited liability companies, LLCs, are taxed just like the partnership. What does that mean? They're going to be pass-through entities. They pass through to the individual owners of these business entities a K-1. And the K-1 is then reported on the individual's return. Now, a little bit of a distinction here. The S corporation files a Form 1120S with the IRS and will report a K-1 out to each of the shareholders in the S corporation, and they take that K-1 and put it into the right places on their 1040. With an LLC, you can elect to be treated as an S corporation. And now you know how that works. We say we're an LLC, we want to be treated as an S corporation. The S corporation creates the K-1, sends it out to us. We put that information on the 1040 form as individuals. The LLC can also say, or the LLC can say, I don't want to be treated as a corporation. I want to be treated like a partnership. We'll file the 1065 with the federal government. We'll get the K-1 from the partnership, and we'll put that information on the members' LLC returns on their 1040s. If you are the only member in an LLC, you will have what's called a single member LLC. Sometimes you'll see the acronym SM, single member LLC. And then you can report your income as if you were a sole proprietor and report it on a Schedule C. On all these cases, it's all paid at the taxpayer level. In a C corporation, the corporation pays the taxes at the corporate level. And the corporation files, the C corporation, the big dogs like Apple, Bank of America, Google, Wells Fargo, they all file an 1120 form with the federal government and the appropriate form with California and pay taxes on that. And so there are different filing mechanisms for each of these. I'm trying to keep it simple here. You have some idea of what goes on with the taxes. If you have questions on the taxes, we'll pick them up at the end when we go through that material. The balance sheet is the next statement we want to take a look at. And again, the balance sheet is a snapshot at a point in time of the business financial condition. there are three main categories: assets, liabilities, and equity. The assets are positive things. These are things that we like. The assets include cash in a bank account. It's money that customers owe us, more technically known as accounts receivable. The components that I have in the back room to make the widgets, that's known as inventory. That costs me something. It has some value to the business. We're going to use it while we have it in our stock as inventory. It's an asset. When we build it into a widget, then we take it as a cost of goods sold. And there's a linkage between the balance sheet and what's happening with the income statement. There's a cost of goods sold. It means the inventory is down. Right? Property, plant, and equipment are the assets of the business, less any depreciation charges. So the idea that we buy computers for the office, we buy vehicles that we use in the business, we have furniture in the office. These are all assets. These assets help us perform the business duties. We buy them, but we don't get to write them off immediately because their lifetime is more than a year. That is the guideline from the IRS. If the lifetime is more than a year, we treat it as an asset. We're going to let you write it off, but it'll be over a time period. So it depreciates, it wears out over a time period. You may have some intellectual property in your business. For example, maybe you have a patent, a copyright, customer goodwill, trademark, things of that nature, contracts not to compete. These are things that are not hard assets. They don't depreciate, but they do amortize, which is similar to depreciation. It's just a different word, and it allows the business owners to write off the value of intellectual property over a time period also. So these are just some typical assets. It's the first part of a balance sheet. We're going to see a detailed balance sheet in a moment or two. The second part of the balance sheet is the liability, and the third part is built in here also, the equity. The liability section are things we don't like to think about. Liabilities include accounts payable. I owe the phone bill. I have 10 cell phones in the field for all of my sales guys and my technicians. I have to pay those cell phone bills every month. Okay, that's a liability. We get a bill from the cell phone service provider and we write the check to them. We get a utility bill. I have to pay the landlord. Maybe I owe payroll taxes to the federal and state governments that are in my bank account, but I have to send off to the federal and state government. Maybe we have a loan. Maybe we have an equity line on the business. I have to make those payments, and there's amounts due over time periods. So we'll keep track of that also. These are, again, the things we don't like to think about as business owners. I owe money to financial institutions for debts. I owe my suppliers for services or goods they provided to us. I don't like to think about those things, but it's money that the business has to use in those directions. The equity position is what the owners put into the business. And here, if you looked at a corporate balance sheet versus a sole proprietor balance sheet versus a partnership balance sheet, they're all going to have some different wording, but they all have equity positions. In a sole proprietorship, it's called owner contributions and owner draw, right? In a partnership, it would be partner capital and partner draw. So they all have the same concept of money in from the shareholders and money out to the shareholders. And retained earnings is all of the money that the business has made over a period of years. It accumulates the profits from each year. This is part of closing the books. When the books close for a company at the end of its fiscal year, whatever the profits were for that year get rolled into the retained earnings account and added to the previous year's performances. So this is another linkage. At the end of the year, we take the bottom line profit from the income statement and we roll that into the retained earnings account. And we're ready to start the new year with the retained earnings account updated from the prior year and the income statement being at zero because we haven't started the new year. So this is the balance sheet. Here's a sample simple balance sheet. And here is the accounting equation. At the bottom of the page here, the total assets equal the liabilities plus the equity. This is called the accounting equation. There are 35 of you in the session right now. You are all now certified accountants. This is all you need to know about accounting. Go tell that to some of your accounting friends. You get some snickers, some eye rolls, but it'll start an interesting conversation that you know the accounting equation. So we know the left-hand side of this slide has to match up with the right-hand side of the slide. And so we list all the assets. We've seen some of these before. PPE is the property, plant, and equipment. We have $100,000 of assets, so I better have $100,000 on the other side. We have $28,000 in liabilities. We look at some of that. We have some payables to vendors. There's some payroll we owe to the employees, and we have a little bit of a line of credit or a loan on the business for 20 grand. The owner has put in 50. The accumulated profits, that's the retained earnings. That's one of the aliases. So the shareholder equity is 72,000, liability is 28,000. The liabilities plus the equities are equal to the total assets. So one of the things, and again, just not mentioning the material, but to be aware of, is please become comfortable with these statements. If you see negative numbers in some of these statements, they don't belong there. I mean, through the years, I've gotten numerous phone calls from people, I'll highlight this one, about accounts receivable in their QuickBooks. I used to do a lot of QuickBooks work, and I don't remember how many times I'd get a call from people who are running their own QuickBooks and say, Bill, my accounts receivable is minus $20,000. Is that good? I'd say, no, that's not good. These numbers should not be negative. So my client was asking a good question. I didn't think they were silly or ignorant or anything like that. I knew what was going on. They weren't using the QuickBooks correctly. And so when you run some of these programs, I want you to be able to do what I call a sanity check. Does this make sense? And to have a negative number for accounts receivable or inventory or any of these payables or a bank balance for a loan due isn't correct. It's not correct. And you know something's wrong. So you have to go back and check your transactions, or you call your accountant or your bookkeeper and ask them to come out and clean up the books so that you get things correctly input to your system. So this is just a simple one. You see another linkage. All of the accounting programs will generate this for you automatically. You don't have to pull all this together. You press a button in the application and bang, out comes your balance sheet for the time period. Now, back to the understanding your statements. Now I want to look at, if this is the balance sheet for January 31st of 2023, what am I going to compare it to? I might compare it to the balance sheet of December 31st of 2022, or maybe I'm going to go back and compare it to the balance sheet of January 31st of 2022. How do I look in comparison to the previous month or at the same time last year? What differences are there? Are these things I expected to be different? So this is just again, a simple example about the balance sheet. The concept of working capital requires us to dive a little bit deeper, but it is important to make sure that you have adequate working capital available to your business. The definition of working capital is buried in the narrative here. Let's get it highlighted. Working capital is equal to your current assets minus your current liabilities. So what are current assets and current liabilities? We discussed assets and liabilities. This is just a finer level of detail, and the concept is all about 1 year. Can I convert these things within a year or pay them within a year? So what are we really figuring out? How much money is available to me in the next 12 months, current assets, versus how much money I expect to have to pay out in the next 12 months? What's that difference? So if my current assets are $10,000 and I only owe $3,000 on a credit line for the business, I have $7,000 available to service $3,000 of upcoming liabilities. I'm in good shape. I have working capital of $7,000. That's fine. And now, if I have current assets of $10,000 and current liabilities I'm going to have to pay in the next year at $20,000, I'm not in such good shape, right? And this is going to get us into some cash flow discussions in the next section of, well, how do I make up that difference? When do I expect money to roll in, right? So working capital is important to understand how much you have. Now, a general rule of thumb I've offered to people through the years is that when you run a business, it's almost like your personal financial affairs. In your personal financial affairs, many times you'll hear that everybody should have 3 to 6 months of living expenses set aside in a liquid cash account in case there's some emergency. Why is it important? I'm going to flip the clock back on you 3 years till June of 2020. What was going on in June of 2020? We were at the very early stages of COVID, business shutting down, people sometimes getting laid off from their jobs. If you had 3 to 6 months of living expenses set aside for yourself and your family, and you got thrown out of your job in June of 2020, you had a little bit of a cushion. You could run around, find someplace else to try to get a job if you could under those circumstances. Move back with family members, take on roommates, whatever it was. You had a little bit of a cushion. Well, businesses need a cushion also. And I apply the same general rule of thumb for businesses. Try to have 3 to 6 months of money set aside in a separate account that you don't use to run the business. It just sits there. It's almost like an insurance policy. If you need it, I'll dip into it so I can pay the light bill next month and keep the power on the factory floor so we can put the widgets together. But I have a cushion to absorb some of this hit that occasionally happens because things change on us. That's the concept of working capital. Back to the point of working capital being the difference between assets and liabilities. And I threw out this idea of 3 to 6 months of business expenses in a business account ready to be used when you need it. So please be aware working capital, that's part of your job of being a manager. Now you can see the general trend here. We give you the concept, we give you an example, and then we tell you, think about your situation, right? What is your situation? What do you need to track in assets and liabilities, and also in the area of equity? So this is, well, I'll save that story for when we get into the cash flow. But think about your balance sheet and what you need to track. And then set up, again, your chart of accounts, your list of things you want to track with the appropriate asset categories and liability categories. Spend some time upfront thinking about this also. It's the same question we saw before. The final statement that we want to take a look at is the cash flow statement. This is like the income statement in that it is an historical look backwards. What happened during a time period? Where did the money wash into the business and where did the money wash out of the business? All right. And that sounds trite and trivial, washing in and washing out. But there are valves that you're manipulating as the owner of the business that can control and direct the cash flow. So everything on the cash flow statement comes out of the income statement or the balance sheet. There's a great deal of linkage between those two statements and this cash flow statement. At a high level, there's 3 types of cash flow: from business operations, from investing activities, and from financing activities. These are the 3 main areas. Inside of these will be references again to balance sheet items and also income statement items. And bottom line, the cash flow statements is over the time period, we have more or less cash at the end of the period in comparison to the beginning of the period. But we want to know where the cash got consumed during the period. That's part of the cash flow statement. Again, it's a look backwards in terms of what happened to it. So some examples of each of these are over on the next slide. Cash flow from operations. What was the net profit? There's one of your first linkages. We're going to add back the depreciation. Now we're getting technical. I know. Why are we adding it back? Some people may be asking that. Because it's not cash. Depreciation is the fact that the machine wore out. It doesn't mean I took money out of my pocket. So that's not really cash for cash flow analysis purposes, right? And so we start with the net profit, we make some adjustments for it, but that's after the business operating. Did the business operations generate cash over this time period? Okay, hopefully it did, and we had profits from operations. Maybe we use that profit in investment activities or financing activities. What's an investment activity? It could be capital investments, sale of investments, and property. All right. So not a lot of small businesses do this capital investment thing, but in terms of having stocks to sell and buy, right? In terms of cash flow from investment activities, there's a couple of items I want to get to here. One may be owner capital investments. A second might be that we have so much money, our treasurer and the financial people in the business said, we can't just sit on all this money and leave it in a bank account. We need to put it someplace else where perhaps we make more money. Maybe we invest in bonds, maybe we invest in stocks, maybe we invest in mutual funds. Now think about, and there are companies around here that have this problem. It's a very good problem to have. Google, Apple, major high-tech companies, Amazon, they have investment divisions within their finance activities of people who study the stock market and study the bond market and invest some of the money that's sitting in bank accounts. It would be neglectful for the stockholders if Apple was just letting the billions of dollars that they have available to them sitting in a bank account. It's their duty to get value for the shareholders. Getting value for the shareholders means putting that money to work until the company finds a place to use it to grow the company or make company acquisitions for Apple to further its goals. But there are divisions in the finance operations of these major companies that do buy and sell stocks. And that's where there could be investment activities that would generate cash flow. Right? Maybe we owned an office building, we sold that office building, we got $10 billion for it. Okay, that's extra cash. What are we gonna do with it now? They manage that. Smaller businesses like we have at SCORE, it's typically owner investments, it's owner draws out of the business, and it could be the fact that we sold a truck or a car or some office furniture. On a smaller scale, there's still cash flow from investment activities for smaller businesses. And for financing activities, it could be that maybe we've taken some of the money that was generated from operations. Remember, and then we opened this slide and talked about cash flow from operations. Maybe that generated some free cash for us. Maybe we use it to buy some stock. Maybe we use it to buy some new computers for the office. Maybe we paid down some loans that we had. So then we took some of the money and we applied it against the loans. Now the reverse can happen. Maybe we took on a new loan and we put it into a bank account. So this will show where the money's washing in from and where it's flowing out to. Again, that's kind of trite phrases. You direct that, you control it by turning different valves. You decide where you want to put the money. You own the business. Here's a sample cash flow statement. Quite frankly, we have 50 minutes left and we could probably spend 20 or 30 going through this. That would be killer. You don't want to do that. I get it. I'm just going to point out the highlights here and you can take it apart piece by piece. Some of the linkages. We have the income statement. On the left-hand side, we have the balance sheet in the middle of the diagram, and the cash flow statement is on the right-hand side. So items from the income statement will flow over here to the cash flow form, and similarly, items from the balance sheet are going to move over here. So some of the things that we're going to see initially, and they're color coded. It's a little bit, if you have a black and white print of this, it's going to be hard to see. You'll have to search for it. We remember the purpose of the cash flow statement is to say what's the difference from the beginning of the period to the end of the period. So the top line is we had $18,000 in cash. At the end of the period, we had $20,000 of cash. We're up $2,000. So we've covered the outer edges. Now we look at the internals. What happened with operations? Well, we were up $6,000. I'm not going to take you through every line here. That would be killer. We're up $6,000 in operations. We turned out $6,000 of free cash. From the investment activities, I can see we're down $3,000. Okay, what does that mean? Well, we bought a new machine for $3,000. All right. And then we had net cash from financing for another $1,000. We paid off some of the debt that we had previously. And so we had $6,000 positive cash flow. We used $3,000 of it to buy some equipment, and we used another $1,000 to pay down some debt. So over this time period, we're up $2,000, and that explains the difference. I took a high level look at it. If you want the nitty gritty details, you can look at the coloring. The net profit from operations is $5,000. Where does net profit come from? Oh, okay, it comes from the income statement. That's over here at the bottom of the income statement. So they are color coded. And similarly, the decrease in AR, inventory, and AP, they are all coded red, and you'll see the appropriate adjustments over here from the balance sheet. So here you can see the linkages. I'm trying to keep this a little bit short, not don't jump into too much detail on you. But this is how you answer the question, where did the money come from and where did it go to? And so this reminds me of a story I started telling earlier, but one of the things that happened years ago was I was going through a financial review with one of my clients. He ran a pool service company. He saw he had like $50,000 in profits under his income statement at the end of the year. And this was October, and we were doing some tax planning. It was a couple that ran it. I was talking to the owner, Rich, and the other owner, Barbara, was not in this meeting with us, but was working in an adjacent office. And I said, well, it looks like, Rich, you're going to have to pay taxes on the $50,000 this year. And he said, I don't have $50,000 of profit. How can you tell me that? I'm looking around here, and he started pulling open his drawers and saying, he was kind of a funny character, and saying, I don't see $50,000 in this drawer. He runs over to a file cabinet. There's not $50,000 in there. He calls out to his wife, Barbara. Barbara, do you have $50,000? Bill says we have $50,000 of profit. Where is it? I can't find it. And she says, no, Rich, I don't have 50,000. She knew his histrionics and kind of rolled her eyes and gave a pat answer. I said, wait a minute, Rich, hold on a minute. Let's take a look at your owner equity, this section of the balance sheet. And that showed that it was negative like $45,000. And so then we dove a little bit deeper and said, well, what happened here? And we looked into his owner's draws. That's money he took out of the business. Said, Rich, what's this Silicon Valley program that you sent $20,000 to? And he looked at me and he smiled and said, oh, that's right, I forgot. That was $20,000 for Sharks tickets for the hockey team. So, Rich, what's this thing over here? It says Vegas. Oh, and that was $5,000, Rich. What happened to that? What'd you do there? Oh, I took a couple of my buddies on a golfing trip to Vegas. Well, pretty soon we went through a couple of things like this, and we were able to find where his $50,000 went, or most of it. So there's a lot of information here. Sometimes you have to dig in behind the details a bit to pull it out. Again, cash flow statement. Some business owners use this infrequently. in my experience with small business at SCORE and previously when I had my own business. The most important statement to most business owners is the income statement. That's what they look at almost immediately. Some of them will pay some attention to the balance sheet, and some of them will pay some more attention to the cash flow statement. The more in depth you get with your business and understanding what's going on, the more you start looking at your balance sheet for some tips about what's happening, and even continuing on through into the cash flow statement. So there's a lot going on with that cash flow statement. Try to give you a high level look at it. Just as important as the cash flow statement, which was a historical look backwards, I want you to do a cash flow forecast. Now we're going to look ahead, right? And you already have a template for that. If you remember from half an hour ago, when we were looking at the income statement, we looked at a simple 1 month income statement, and then we flashed to another slide, and there was a multi-month income statement, which month by month of the first 5 or 6 months of the year showed the revenues, the expenses, and the bottom line of this business. That's the template for a cash flow forecast, to take a blank spreadsheet like that and to plan out the next 6 to 12 months. Where's the money going to come from? How much are we going to sell? What am I going to have for payroll costs? What's it going to cost for rent, utilities, all these different things. You need to do this projection of cash inflows and outflows. It's very important for business owners, particularly if you just started up. I've had a couple of calls from people who started businesses 6 months later. They're in trouble with their business. They're in danger of losing it because they don't have enough capital to sustain it. And they didn't spend time up front thinking about what it was going to cost to start the business and what it was going to cost to run the business. So if you're thinking about starting, do a projection. If you're already in business, you have an idea where you're spending the money, you still need to do a projection, because you want to anticipate when there's going to be shortfalls, and in knowing when the shortfalls may occur, you can be proactive and take some actions to try to minimize the impact or avoid it entirely. So it takes a little bit of effort, but it is important to do. Here's the key word. I've been on the soapbox. You must proactively address problems and shortfalls. And there's lots of different ways to do that depending on the status of your business. Do not mess with the tax obligations that you have. Pay them on time. Again, I've done a lot of tax work. I've represented taxpayers, individuals, and business owners who are in trouble with the IRS. I've discussed with the IRS these situations and try to minimize the impact on my clients and get them out of trouble. But the IRS, the Franchise Tax Board, the Employee Development Department, the CDTFA, the California Division of Tax and Fee Administration, where you deal with them for sales taxes that you might collect. They want their money. They want it on time. They will make your life miserable if you become what they call non-compliant and not meeting your obligations to responsibly handle the funds you've collected from employees for payroll taxes or customers for sales taxes. So please be very careful there. Don't use that money for something else that just makes the hole deeper. Some things to know with regards to financial statements. Lots of different rules. You may hear about GAAP. It's generally accepted accounting principles and procedures. You can be generally aware of it. You don't have to know it line by line. Even your accountants, depending on the size of the business, may not be strictly enforcing all generally accepted accounting principles and procedures in your system. For most small businesses, a lot of this can be overkill. And part of it is there's different ways you can account for inventory, how it can be valued, when do you recognize your income and expenses. There could be some leeway as far as what's capital expense versus an operating expense. Before, when I said, if something has a lifetime of more than a year, generally you call that a long-term asset and you depreciate it over time. In some cases, if it's relatively inexpensive, and relatively inexpensive is a loose term, I realize that, but I found through the years that different accountants and tax groups have different thresholds where they say, oh, it's $200. And yeah, I know that calculator you bought with a special module in it that's going to last you more than a year. It's only $200. Just expense it. Don't worry about it. You're not going to depreciate it for 5 years. That would be silly. It's a nominal amount. Other people say, well, if it's more than $500, we'll capitalize it. If it's more than 1,000, we'll capitalize it. It's really relative to your business size and the revenues that you have. And the bottom line, all of this is it can be complicated. You may want some professional help. There are many good CPAs and enrolled agents, people around who can help you understand some of the ins and outs of the accounting principles and try to keep you on the right side of things. So it might be worth this to have spend some time and money with your professionals to make sure that things are going in the right columns, so to speak, because these statements get used for many different purposes. There are some formal reports that you'll file with the IRS, Internal Revenue Service. SEC is the Securities Exchange Commission. If you're filing to go public, which a lot of the small businesses that score never dream of doing, they'd fill out different forms. So there's different formats. These formats may not be really what you want to operate your business. The statements, you're going to use them first to operate your business. That's what I think is the primary use of these statements. You're going to use them clearly. Some people say, well, I need them for taxes. You're right, you need them for taxes. But more important than taxes are gathering the financial information, understanding how your business is performing financially, and making financial decisions that are sound, that you're confident in. That's just as important as this idea of tax preparation. You may want these financial statements to go and see lenders or potential investors, right? So presenting yourself to lenders and investors, making good, sound financial decisions with confidence, and tax returns. There's 3 main places you're going to use these financial statements, and you may have to move things around a little bit to accomplish some of this and meet some of the needs. But, you know, one more trip back to the pandemic. Remember again, in April of 2020, May, June of 2020, the government came to the rescue. And they started the PPP programs, the Payroll Protection Plan. Through the SBA, there was an economic injury disaster loan known as EIDL. At SCORE, at that time period, we're getting phone calls from small business owners, lots of them, every day, about how do they apply for these things? What do they need to do? We were helping people out, but it was really sad. There were some people who didn't have their financial act together, and they were at loose ends. And there were people who had their act together, and because they had their act together, and what I mean by that, having their act together, their books were up to date. If it was April, they had finished their tax return for 2019, or they were close to finishing it, and they had all their financial papers through the end of 2019 completed. If they didn't have their act together, their papers were not completed, they were not finished, they were still reconciling statements and making entry for 2019 books. And now the pandemic hits in 2020 in April, it gets really bad. The government rushes in, says, we'll help you guys out. You can apply for loans. We'll give you these paycheck protection program plans. If you behave appropriately, the money's free, basically. It'll be forgiven. And the people who got to the front of the line were the people who had their financial act together. We would tell them, you need your financial statements. If you have your tax return, get all that bundled up for the last 3 years, go off and see some of these lenders, right? They got to the front of the line. The people who had to scramble to pull things together to make a good presentation for themselves, to get serious consideration for this money, they were at the back of the line because they had to spend all this getting ready time. So be ready. Keep your books up to date. It's good financial management to be on top of this. Off the soapbox, we're coming down the home stretch. We have a good half hour or so here to talk about getting behind the numbers, some of the issues associated with that. They're very useful to you. This is a drum I've just been beating about. You use them for management purposes. Some of the basic tools we'll use, and you'll see this in the next several slides. This is really an introduction to the last section of the presentation today. It's having a knowledge of the details, being able to do comparisons that we'll do for the business. And some of these I've mentioned already, right? We want to compare your current results against previous periods. We want to compare your results against your projections. So I mentioned the importance of a cash flow projection earlier. Now we want to look back 6 months later. At the end of June, what am I going to tell people to do? I'm going to say, well, you made a cash projection back in December for January through June. How did it turn out? Are we close? Are we off? Where are we off? Why are we off? So once you start looking at the numbers, then you do all the critical thinking and analysis by asking those, why are we off? Where are we off? How do we get off? What are we going to do to correct that situation if it needs to be corrected? So we do comparisons. For most small business owners, the comparisons are where most of the analysis goes in analyzing the numbers. There's some ratios you can be aware of. The ratios are important to look at these in terms of industry comparisons. You don't compare your technical consulting firm that's doing high-tech software applications against somebody who's running a construction company. That's apples to oranges again. You want to make sure you're exceeding your break point. You want to try to push that spread even higher. And then there are some critical indicators that are going to be subjective. It's going to be based on your industry and your business and how you operate it. So some of the places to get some statistics on this business-wise, I'm going to type in some names to the chat box here. Bear with me, I'm a terrible typer. Okay, so here's a couple of websites, a couple of other places you can go. Labor statistics. Industry groups, that's a good one. If you belong to an industry group, an affiliation, sometimes they will share information about how people are performing in that industry. Okay, all the typing's done. Sorry, thank you for your patience. So for example, I belong to a tax group. Every year I fill out a survey I would fill out a survey in the past about different clients, how many tax returns I did, things like that. A few months later, the industry group would say, well, we've completed the survey across the country. We've compiled the results. Here's your copy. It was kind of interesting to see how I matched up against some of the competitors, similar sized businesses. So these are some places where you could do some digging. Oh, before I forget the San Jose Public Library. You may want to go down to the MLK Library on San Fernando and 4th and go to the business section. They have a wealth of information. They have some excellent researchers who will help you dig into some of the details here and help you find information that's relevant to your situation. That's, of course, if you're in San Jose. That's right, and you guys are out in the valley. You may be able to get to some of this remotely through the web. And check the, out in Fresno, there's Fresno State. Bakersfield has a state college too, I believe, or Fresno University and Bakersfield State College. Some of those college libraries might be able to help you out with some business information also. So these are some places to get it. Now we're going to do a little bit deeper dive on some of this knowledge of the details. So what's happening in your business? This is very evident to people for the most part when you see these examples. Most small business owners know what's going on within the business. Here are some extraordinary examples. Large customer usually orders twice a year, but they buy a third time in December. Well, that's good news. They bought a third time in December. What does that mean to us as a business? Well, I'm looks like I have some business coming. Maybe I have a sale this December that I wasn't expecting till next year. Or maybe it means that I'm not going to get that order next year, and I'm only going to get one order from these guys next year. Maybe I want to tuck away some of this money someplace. Some of the fires around the state in the last few years, there's been lots of lumber sale, and we all know why that happened. The lumber yards are happy for that. They're sad about the rationale why it's occurred, but they're glad to have the business and will supply it because there's a need. So that's again, we know why we sold so much lumber, because we had the terrible fires. This classic example of Y2K, we need to get that updated. That's getting a little bit long in the tooth. But 25 years ago, there was concern that the computer systems of the world would not be able to handle the switch from December 31st, 1999 to January 1st of the year 2000, and they weren't programmed correctly. It turned out to be a big don't care issue. But a more recent example, again, would be the pandemic in 2020. If we're comparing financial situations, in 2023, you might look back at 2022 for your performance of 22 against 23. You might go back to 21 and look at it. But you might say, that's really not very good in 21. What happened in 20 without thinking about it? You might just have the computer look at that. So that was an awful year. All right, that's the pandemic. We never want to see that again. You know what's going on. You know why the numbers are off. We're not going to go into a deep dive on that and try to figure out what types of business changes we need to make on it. So there are some exceptional items, and then there's going to be items that you planned for and maybe you hope to see. And part of that might be a change in some of your numbers. And this is why they like to do percentages, or some people like to do percentages. So this is a comparison of a P&L, also known as an income statement, of 2 years for a company. And let's say prior year, they had $47,000 in sales. This year, they had $50,000 in sales. So that's pretty good. What are the ratios here? We had material costs were up $3,000 this year, and our labor costs were up $1,000. So we had $30,000 in cost of goods and a gross margin of $20,000. Last year, we had $21,000 of gross margin. We're down $1,000 here. And now you can see some of the numbers. There are significant jumps here from 45% cost of goods down to 40% cost of goods sold. We lost some margin there. So this is, again, a comparison. Now you start asking questions, right? Now, another thing you might do is at the end of 20X, maybe I planned in November, and the next year in 20Y, I'm going to bring on a sales guy. I expect my commissions to go up, and I expect to see some improved performance as a result of this. So I would expect, when looking at my 20Y numbers in a year, that projection should come through with higher costs of commissions, but a big jump in sales generated by the new commission person. So when you do the planning and you do your projections, you'll build in the economic impact of some of these management decisions that you're making for the business. And the test results are in looking at your financial statements down the road and seeing if the performance that you had hoped to achieve was actually met, surpassed, or perhaps missed. So the comparisons really are very important and done very frequently by business owners. And by frequently, I don't mean you're doing it every day, but at least a couple of times a year, you're looking at, how did we do? Are these meeting my expectations? What do I need to change to get better results? The same thing with the balance sheet. Right? We're going to compare the balance sheet from the previous period against the current period, notice changes, and see if things are good or bad. Now, here's accounts receivable. I always like picking on accounts receivable. It's kind of a touchy subject for people. Last year, accounts receivable, $18,000. That's $20,000. What's my observation? Receivables are up. What's the deal here? right? I'm asking questions. Are we slow in collecting? Now I want to know, well, why are we slow in collecting? That means the customers aren't paying us. Now I want to talk to some of the customers, right? And there's two things I want to do in talking to the customers. One, I want to confidently ask for their money. Don't be afraid to do this. This is a touchy subject again. If you start a business, maybe you're very technical, maybe you're very creative, and you're not comfortable asking people for money. You are entitled to the money. Ask them politely, ask them professionally. I'm going to go through the method, then I'm going to come back to the management issues. So the method when you're asking for the money is to be polite. Hello, this is Bill. We sent you an invoice. We're just wondering, maybe it was overlooked. If you have a chance, please send us the payment. Very gentle reminder. Right? Another time period goes by, a couple of weeks, a month or so. Now I'm going to maybe I'm going to make a phone call. Call them up, say, hey, this is Bill. It's been over a month. We haven't received a payment. Is everything all right? And now we're getting to the management side of things. And the person on the other end of the phone may respond and say, well, we're running into some problems here. We're getting pinched on our business. We're not selling as much as we were. I'm not able to pay you now. I know it's 45 days. You're like 50. I'm confident I can hit 60. I'll get it to you in the next 2 weeks. You may say, okay, but tell me why you think your customer sales are off. Because this could have an impact for me down the road, right? This guy is going to be buying as much for me, for his customers. I'm not going to need to order as much. Do I have to change my hours for my people? Is there a recession coming? What's going on here? I need to dig a little deeper. I'm not going to beat the guy up over this. I'm going to dig a little bit deeper, right? Maybe the answer isn't what I just gave you. Maybe the answer is, well, the last bunch of stuff you sent us was no good. It all broke as soon as we took it out to set it up. And now I got a customer relations problem, not a collections problem, really. The collections problem was masking an underlying issue that I just discovered, and I need to address that pronto. So ask some questions. Don't be afraid to ask questions. You're doing your business activities. You're going to learn some things that will help you with your business, either in planning for the future or perhaps addressing some past problems that your business created, because you want to fix those problems. You don't want to get your customers upset and have them talking poorly about you around town. So I dove a little bit deep on that accounts receivable, though. It's part of the management, to ask questions, address issues, and understand the economic environment. So again, balance sheet, some good comparisons that you can do based on past numbers and some questions to ask folks. Here's a very high level look at a cash flow statement with regards to sources and uses of funds. The sources are over here on the right hand side. We have profit depreciation. We had $2,000 less in cash, $1,000 more in payables. So we had $9,000 available to us. And then how did we use it? We had, well, part of it's consumed in receivables we haven't collected. We put more into inventory. We bought the machine. We paid down some debt. So there's the 9,000 funds. Now I know where the 9,000 was applied to. That's very simple executive level look at a cash flow statement. And most small business owners know this, though. I mean, that's been my experience and why I made the statement earlier, that the cash flow statement is probably the least looked at statement of the three, because most small business owners know, oh, that's right, I did buy the truck this year, or we did pay off a significant amount of the loan. That's where some of the cash went. And you're really just confirming some financial decisions that were made earlier. Ratios are interesting. Some of these will be appropriate to you. Some of them won't be appropriate to you. I typically don't spend a lot of time on these. I'd rather take questions. Most small business owners don't really look at debt to equity ratio. It's similar to what we were talking about before with regard to working capital. This is a deeper dive on that because it looks at the debt divided by the equity position of the owners. The working capital was just assets, current assets minus current liabilities. Here, this is more as if you were investing in a company. How much debt is shared by the equity ownership position. If it's 1-to-1, it's generally okay. Some businesses, you can have different ratios. Airlines, for example, carry a lot of debt in comparison to a place like Apple that doesn't carry a lot of debt. They're going to have completely different debt to equity ratios. An airline ratio might look bad in comparison to Apple, but American Airlines debt to equity ratio may be fine in comparison to Delta and United. Do apples to apples comparisons. Return on equity says how much, what's the profit divided by the owner's equity? How much everything that's invested here, what's the return on that? What's the profit on it? And so here's a quick example. We had a profit of $5,000. The equity is up to $72,000. So the average is 69.5. That means 7.2% return on equity. Now, who uses this? Some owners use this. Very rarely have I seen small business owners use the return on equity as measuring their well-being in a business. Who uses it? Sometimes investors will use it. They'll want to know what's the return on equity currently. If it's 7.2%, that helps them decide if they want to make an investment here, because they have investment choices. If they become an equity owner of this business, maybe they can expect a 7.2 return. Maybe that's not acceptable to them. They're looking for a higher risk investment and might look for a place with a return on equity of 10%. So some investors will use that. Most small business owners are not wrapped up actually in either one of these ratios. The current ratio is just the current assets divided by current liabilities. So it's a little bit of a switch on the assets minus liabilities. Remember, current assets minus current liabilities is working capital. Here we have a current ratio where we divide the current assets by current liabilities. It's kind of measuring the same thing. How many dollars are available for every dollar of liability? And so we want a number greater than 1, and many times the lenders will look for current assets at 2-to-1 or even higher for liabilities, because they're going to, if it's a lender, they're thinking about adding to the liabilities. They want to make sure you don't have too many liabilities already and will not be able to handle the loan that you're applying for. The days sales outstanding, this is a measurement of accounts receivable. We take the receivables divided by the average daily sales. Let me get both of these highlighted on this slide. And that tells you how long it takes to create, to collect on your receivables. And here, the days sales outstanding calculation works out to be 146 days. This is no way to stay in business, letting people use your goods and services for almost half a year without paying you, completely not acceptable. So that's, again, where you're back to the program of managing your receivables and trying to get timely collections on them. How fast these two forms about inventory, turnover, and days of inventory, they measure the same thing. How long do we hold the inventory? And it's really, one is the inverse of the other. The first one is cost of goods sold. The second one, we're going to divide inventory by cost of goods sold. So they're basically the same. If the inventory is 1, that means we turn the inventory over once every year. If this is a grocery store, that's not a good turnover. We're not going to have fresh produce in there, right? If you run a jewelry store, yeah, your turnover is not going to be as frequent as a grocery store, right? An automobile dealership, they're going to be turning it more than once a year. So depending on the industry, there'll be different inventory turn rates that you might see. The break-even point is very important. You want to exceed the break-even point. The break-even point definition is really the number of units you have to sell so that you have enough to, I'm sorry, I want to get that highlighted. The break-even point, number of points you have, is the number of units you have to sell for the gross profit so that there's enough remaining to cover all your other costs. A lot of words late in the session. Let me give you some quick numbers. This group sells 5,000 units at $10 a piece. So they have $50,000 worth of sales. They have a $20,000 gross profit, or each unit they sell generates $4 of profit. this is good to know, right? Could be, again, in the donut shop, maybe it costs me $1 to make the donut with labor and ingredients, and I sell the donut for $1.25. So I have a 25-cent profit on each donut I sell. My question is, well, how many donuts do I have to sell to keep the place open for the month, right? And here in this case, we have $4 of gross profit per unit, not per donut, but per unit. But we have $15,000 of other costs for the light bill, for the cleaning of the shop, for the insurance. We have to cover $15,000 more. And so how many more units do we have to sell? 3,750. All right, 3,750 additional units so that we generate another $15,000 and keep the lights open, the lights on and the doors open. To sell 3,750 more units, we have to make revenue equal to 37,500. All right, and we have to sell that amount of profit, that amount of product, and then we'll be turning a profit on the business. So that's the idea of the break even. Please try to calculate that for your business. Your mentors at SCORE will help you with that type of calculation. The critical indicators are going to be industry and company specific. And this again is where you're going to get some information outside of your financial numbers. On the accounting programs, we can track how many sales are in the pipeline, how many unfilled orders we have, how long does it take to get an order. We send the commission sales guy out, they have to make 3 presentations, it take 3 months before we get a signed contract from someplace, right? These are non-financial pieces of information that are available through the accounting systems, right? If I have new customers, what do I typically charge them? Do I get repeat customers? How much sales do I get from them? These are all finer levels of detail that are available within your accounting system. That's why it's important to set them up and then set up the accounting system to accommodate these data points that you can collect so you can make better financial decisions down the road for the business. Summary of this, be real quick here. There's a lot of information in these statements. Set them up right, set up your bookkeeping correctly. Be aware, hopefully, of the conceptual goings on, the conceptual facts of the income statement over a period of time, company performance, balance sheet, at a point in time where we are financially, what's the lifeblood, what's the financial position of the company, and the cash flow is what do we do with the cash during the time period. So we covered a lot of ground. Again, my hope was that at least we got some concepts out for you that you could feel more comfortable wheeling and dealing in this financial world. You don't need to get a degree from Wharton and in an MBA. You don't need to get your CPA license. The closing soapbox point is have some general understanding of these so you can make better decisions for your business, so you can get a decent return on your investment for the business, and you're able to grow the business. And that reasonable compensation idea is very important. You will never work harder in your life than you will in your own business. You're going to pour your soul and your heart and your blood and tears and sweat into this. You should get some reasonable compensation for it. Make a profit, reasonable profit, so you can live the lifestyle you'd like to lead and take care of your family and loved ones. If your business isn't getting there, you have to take the steps to get it there and make the management decisions to make those changes. So please, I'll get off my soapbox, but make sure you're generating a reasonable profit. Profit is not a bad word. You're at the tail end of the session when you receive the material. There are some websites that you can take advantage of. And here's the very important information about contacting your local Central Valley SCORE with their phone number and website. And we want to thank everybody for coming. I hope you got something out of the session. And, you know, we have some time to take some questions. Let's see, I see one in the box. I'll jump on it here. Would I kindly explain EBITDA in detail and provide an example? We could spend an hour on that. So I'll give you a quick conceptual review of it. So it's the earnings before interest, taxes, depreciation, and amortization. So what we're looking at is the earnings of the business before we consider all of these other costs of the business that don't really have to do with operating the business. It's just things that are associated with it, but it doesn't tell me, these things don't help me understand business profitability. EBITDA is used most frequently for large companies and for stock market valuations and making decisions. It's part of, it is a factor used by people in making decisions about buying and selling stock, tracking EBITDA. For most small businesses, I believe it's overkill to be diving to that level of detail. Now, if your small business is growing from a small business to a medium business, and you start talking to angel investors, and you start talking about going public, you may want, then you're going to get involved in EBITDA. For most small business owners, these items are not significant enough to dive into the details and track them. They're going to show up on your financial statements anyhow. Splitting them out is more data than you probably need as a small business owner. So if you want an example of this, go to any publicly traded company. You could go to Morningstar.com, you could go to Yahoo Finance, you go to Bloomberg. These are some of the financial investment websites that you could use to pull up company financial statements and look at the EBITDA of Apple, Bank of America, American Airlines, Safeway grocery store, any of these places. So that's just a little bit on it. There's hours that you could spend in seminars on EBITDA. I hope this helped a little bit. I don't mean to be offensive. I hope it helped you a little bit. Feel free to ask any other questions you might have. Christina, if you're aware of questions I've missed, please let me know.
No, Bill, thank you very much for the presentation today. That was excellent. I don't see any other questions. I do want to thank everybody for attending today's webinar. I will be sending the link to the recording and the PDF presentation that Bill presented today to all of you. Okay, I don't see any other questions. Bill, thank you very much for your time.
No, thank you it's been a pleasure to be here. I hope everybody got something out of it, and I appreciate the opportunity to help out as best I can. Thank you, Christina.
Thank you. Bye, everyone.